This is Adam Hooper here, CEO and founder of RealCrowd, and welcome to today's webinar. As many of you know, RealCrowd is a direct investment platform that provides access to real estate investment opportunities around the US. We've had over $8 billion worth of real estate on the platform since our founding and have processed thousands of investments for our members. We've also recently launched a subsidiary platform called Reallocate, where we're working with registered investment advisors to help their clients understand where private real estate fits into their portfolios on a risk-first basis. As part of that program, we've been fortunate enough to build a relationship with Mariner Wealth Advisors, a full-service financial advisory firm based in Kansas City with a footprint around the country. We've always appreciated their 360-degree approach to wealth management and planning, and are working with them to help RealCrowd members gain a holistic picture into their financial and planning goals. You can visit buildmyroadmap.com if you want to learn more about that relationship and schedule a call with us to discuss. Today, though, as Tyler mentioned, we're joined again by Jeff Krumpelman, Chief Investment Strategist and Head of Equity Investments at Mariner, to give us his mid-year crystal ball outlook on the equity markets and what we can expect to see as we somehow already find ourselves in the back half of 2021. If you have any questions throughout the presentation, please utilize the chat function in the webinar viewer, and we'll be sure to ask Jeff any questions as they come up, and as Tyler mentioned, are planning on having some time for questions at the end. With that, we again thank Jeff for his time today, and Jeff, we'll turn it over to you.
Great, and I'll queue up some slides here. Just take a moment to do that. Hopefully everyone can see these slides on the screen. So appreciate that, Adam, the introduction, and here we are at mid-year. I think sometime earlier in the year, every January, we come out with our crystal ball kind of forecast and what we think is going to happen for the year and the scenario, the environment that we see as the backdrop for those returns that we're looking for. So at mid-year, we like to kind of do a review of what's occurred, what played out the way we thought it would, update and see how we think that impacts the balance of the year, and really looking at a 12-month horizon whenever we talk about where we think the market is headed. So as a preface, let me just say that we were very optimistic, had a positive outlook on the market as we headed into the year. And specifically, we had a target of 4150 for the S&P 500 for calendar year end, and that was roughly a 13% return on the S&P 500, which is a pretty handsome return. Here we sit at 4,400 on the S&P 500, and folks will, of course, it begs the question, well, Jeff, are you going to update that target? And do you feel like we're overpriced, overvalued? We've had a lot of things happen this year. Bitcoin was on fire for a bit. We had the so-called meme stocks that were out there, the GameStops, the EMCs that folks were just all Twitter about. And there was, I think, just a continued feeling that maybe we've got some froth and some bubbles that are developing, and this just can't continue. We actually are updating our forecast. You'll see in just a minute. We're taking our S&P 500 target up to 4,600 for the next 12 months if we will look through June of 2022, and it comes back, as it has for us each and every time, to three things that we look at in assessing the market: the fundamentals, the valuation levels in the market, and the technical price trends. And if we see a lot of check marks in each of those categories, then we feel comfortable that the market still is on good footing. And we do have a lot of check marks in those areas: a robust economy, solid earnings, low rates, accommodative Fed, tight credit spreads. Those are all good things, and they continue to be in place. That said, we do see signs, just as a executive summary, of some slowing momentum in the market, and would not be at all surprised to see some type of correction within the next 6 months before year end, or a stall, if you will, in the market to allow earnings to continue to catch up with price level of the S&P 500. And there are some wall of worry items that are out there that could cause some temporary kind of pullbacks in the market. Concerns about tax policy next year. What about accelerating inflation? Is the Fed behind the curve? Those are all things that are out there. And then this idea of a peak in the economy and what that means. We think each of those wall of worry items will be adequately maneuvered through and managed, and that the fundamentals, the valuations, and the technical price trends that we see as all positive will carry the day. So we'll talk about all this in the next 30, 40 minutes. But let's look at this first slide, just a quick review that I think helps sets the stage for some of the comments I'll make about what we see going forward. And if we look at the returns, this is through mid-year, just to refresh. We've got returns. There's the All Country World Index, which is a global index combined of US and international securities, up 13%. We have the S&P 500 up over 15% for the 6 months. Small cap stocks did even better, up 17%. And then you can see the international arena also in high single-digit territory with regard to return. We really like the fact that this was a broad-based advance in the market that says that there is confidence. It doesn't look like folks are looking for this to be a kind of bull market peak. It wasn't led by just a few stocks, a very narrow market. The worst thing that really can happen is where you just see a handful of stocks carrying the market and most of the market being weak and just the big caps doing really well. We didn't see this. We saw broad strength, and that does portend well for future returns. If you look at that right-hand column, you can see that we had really robust recovery off of the March 2020 low. You saw from March 23rd through the end of June, the S&P 500 almost doubled. It was up 96%. Russell 2000 up 134%. And the two comments I'd make from that is that, again, if you would have gone back to that February-March period, there was a lot of pessimism that was out in the market. A lot of people were looking at the headlines. We can continue to stay focused on the data. What were the fundamental drivers? What was policy that could keep personal income at very high levels, keep the consumer in good stead for spending going forward, and those elements remained in play along with low interest rates, tight credit spreads, all those factors I just talked about. And so that gave us the confidence to say, hey, hold your ground, stay invested, and not encourage or allow our clients to suffer the whiplash of selling in that 34% swoon that we saw in the market in March. It was about a 3-week swoon in March in the S&P 500, and miss out on these robust returns in the right-hand column. Now, having said all that, I would admit that after you've seen those returns, we've been probably a little surprised by the swiftness and the magnitude of the recovery and the returns that we've seen so far this year. But I'll never apologize for underestimating where the market's headed. We're just trying to get the trend right. And again, we go back to those underpinnings, fundamentals, valuations, and technicals to try and assess the trend and where it's headed. And let's remember that as we were kind of climbing the wall of worry through this, we were looking at a potential contested election. We were asking ourselves, are we going to get the stimulus, and how will coronavirus be managed? Will the vaccines and vaccine dissemination be successful in the US? No major hiccups. Those issues have been resolved, and there are ones ahead of us. But I think that's what enabled the market to do what it did. And we think that the environment also and the issues that we see today will be managed well, not without correction, not without pause, but over the next 12 months that we'll see relatively healthy returns. Let's look at the next slide. Here, I just want to make the point that when I talk about corrections, potential, stall in the market in the short term, a couple things about that. That's not something necessarily to fear. We think it will be healthy. And this chart goes back to 1980. The gray bars show the calendar year returns for the S&P 500, the annual returns each year. And you can see most of those bars are positive and they move up. There are a few years, very few, where those gray bars are moving down and you saw negative returns in the market. But even in those years where they were negative, notice that most of them were not significantly negative, kind of in that -6 to -10% territory. There were a few where you had some outsized losses, but in most cases, you can see the red dots capture the intra-year corrections that you see, and many times it's not unusual at all for you to have short-term corrections that you get through. For example, in 2020, you had a 34% decline in the S&P 500. You see that red dot, and yet the price return was positive 16%. The total return was positive 18%. So the market will do that. It will give you these corrective periods, and most of those corrections are driven by psychology. It's news items that are out there. In 2016, it was, Brexit. That's going to cause a global depression. Supposedly, folks were very concerned about the presidential election that year with Trump. And in 18, it was all about tariffs and tariff rhetoric, and the fear that we would have not tariff discussions, but a tariff war, that the Fed would make a big policy mistake. And they started speculating that we were going to have a recession as a result of those factors, and it never came about. And then in 2020, it was pandemic. In each of those cases, you needed to look underneath the surface, underneath the hood, look at the fundamentals, the valuation levels, and the technicals. And the economy continued to grow in each of those periods, with the exception of the pandemic, where we had a forced temporary shutdown and a quick V-shaped recovery. But you could look through that and see that valuation was reasonable or attractive. Fundamental trends were positive, and technically the market showed signs not of a run towards fear and defensive names, but the more aggressive areas of the market continued to perform well, and that gave us the confidence to stay invested. So corrections you can maneuver through. It's okay to be negative in the market, but this is an industry where being an optimist generally pays off, because the market is up 75 to 80% of the time. If you're going to be negative, you better have the data behind you, the negative data behind you, to support that, because most of the time the market will climb the wall of worry if those factors that I mentioned remain positive. So why am I saying that we might see some type of correction in the near term, and yet I remain positive on the market over the longer term? That appears on this slide. This shows you that the S&P 500, in terms of the percent of stocks that are trading above their 200-day moving average in the red, still we've got over 90% of stocks trading above their 2-day moving average. It says there's pretty good momentum over the longer term, and most stocks remain in a long-term uptrend. And yet, if you see what's happened over the last 50 days, we have seen some momentum fall out, and the percentage of stocks trading above their 50-day moving average is fallen to the 50% or below level at this point. So the market's kind of signaling that it might want to take a bit of a rest, which shouldn't be surprising given some of these wall worry items that we see in the news, and the fact that we've had the strength and the rally that we have. For it to take a pause or a rest shouldn't be surprising whatsoever, but that doesn't mean you're at a bull market top by any stretch. Also, if we look at higher beta stocks, compared to low beta stocks, whereas they had been in a strong uptrend where you had the more aggressive areas of the market within consumer discretionary and technology, the industrials and materials, those stocks really leading. They've kind of flatlined over the last couple of months as we kind of deal with and struggle with, hey, is this inflation going to be transitory, or not? Is economic data peaking? And if so, what does that portend? We've seen just a little bit of that momentum come out of the market. So that's why I say, it seems like the market does want to rest in here before moving to higher highs from a technical standpoint. Doesn't mean just because I'm talking about reasons why we might have a correction, doesn't mean that we have to. And it doesn't mean that just because you've had a super strong first half, that historically the second half, has been a tough second half. We looked at the top 15 first halves on record for the S&P 500, and this most recent year, in fact, falls within the top 15th. It's the 13th strongest that we've seen on record. And if you look at these top 15 first half periods, what's interesting is in the blue, the table in the blue shows you that on average, the second half, 73% of the time is positive, and the average return, if you look at that far right column in the second half, is about 6.6%. So we're not doomed to negative returns just because we've had really strong returns. That's again why I look, underneath the surface and look at some of these technical trends within momentum to see what it seems to be telling us at this point in time. And it does seem to me to be saying, hey, I want to rest a little bit. Yet that may not be the case. Maybe we'll continue to have kind of these rolling corrections that we've seen within sectors, not the aggregate index, kind of pull back in a 10% to 15% fashion, as I wouldn't be surprised to see. In the month of July, we saw energy stocks down about 8%. We saw financial stocks down in negative territory, and yet the S&P posted a 2% return for the month of July. Earlier in the year, we saw the NASDAQ correct about 10%. So maybe we'll just have these rolling corrections, across the different sectors. That could be another scenario. And because of the churn that we're seeing in the market, we've recommended our clients that we have a very balanced portfolio between growth and value. I think it's a time to be diversified and have a blend of those two versus many experts that are saying, oh, we ought to run to all these, old economy stocks, these reopening types of stocks. I think technology will continue to do quite well and is exposed to catalysts that will drive earnings for some time. The 5G, the move towards advanced driving, and cloud and data center. I think that we want to continue to have a nice blend of those types of technology-oriented stocks as well as the cyclicals. And within cyclical land, I think that you want to be exposed to those that are very innovative. Examples within the consumer discretionary area, we have exposure to Aptiv, which is an auto supplier that's very leveraged to the move towards advanced driving and making components that are involved in both electric vehicles and advanced driving. And I think innovation is key even within your cyclical exposure. So what we got right in the first half, we thought that S&P 500 earnings and economic growth would be very healthy and would support the solid stock market. I think we were pleased that that's kind of the result that we saw when many were kind of pessimistic about how vaccine dissemination and economic reopening would play out. We thought that inflation would become a concern, but that it would be manageable. I think we still feel that that is the case. It's going to accelerate, but not to those margin destroying levels. We thought that rates would rise. We got that right for a while. I might have to move that into the other category. as Treasuries approach the 1.75% mark, they've dropped back to less than 1.2% at this time, and we thought they would trade in a range of about where they are now up to the 2% plus level. But the point is, I think that we do think that rates will not surge and not plummet, but stay in kind of a sweet spot, if you will, that will be supportive of the market. And we thought domestic equities would outperform, and they certainly did handsomely in the first half. What we did miss was a strong push into cyclicals in that first part of the year. We were blended throughout, and the perfect portfolio would have been heavily invested in financials and energy for the first 4 to 5 months of the year. What's interesting now is that has right-sided itself, and now you've got the cyclical and the non-cyclical categories of the market really at parity. Growth stocks have performed absolutely in line with value stocks, and that gap has been erased. So we missed that in the first 4 or 5 months, but at this point, you could move that into what we got right column, that you wanted a blend between the cyclical and the non-cyclical. So here's just the forecast that we see for mid-year 2022. We, in the base case is in the green, we assign a 65% probability to an S&P 500 level of 4650. That would represent 8% price return from where we were at June 30th, 10% total return. And the environment that would describe that kind of still healthy, not crazy robust, but still healthy return would be economic growth through the calendar year of around 6 to 7% in terms of real GDP growth. We certainly have had a very strong V-shaped recovery. It is going to slow, but we think it will slow to still healthy levels. We look at 2022, we're looking for 3% growth, and then that will decline and kind of steady out, we think, going forward at the 2% level, but still healthy growth. We don't see recession, in view at this point in any way. A Federal Reserve that will remain accommodative. We'll get some numbers out this Friday on the jobs report. They've been solid and strong. The ADP jobs report that came out today was a little soft. And if it is just a little soft, I think that will give the Fed even more cover to remain accommodative for a fair amount of time. And then we see interest rates trading in that range of 1.25 to 2.5% or so. So rising over time, and we think they will, but not the levels that will be of real concern. Now, we do think that there's a small probability that we get what one might call a blow-off top, that we could see a 5,000 handle on the S&P 500 by mid-year 2022, and that would happen if inflation really did turn out to be pretty benign. I think there's fear out there right now that it's going to accelerate, and that's keeping investors a little skeptical and sober. PE levels at 22 times aren't cheap, but at these low level of interest rates, they're very reasonable. They could rise to the 24 times level, I think, if folks really got confident that inflation was going to be contained and that the economic growth, while peaking, was going to slow to still healthy levels. And that kind of is our view. If we did see 5,000, that would be probably a moment for us to be more cautious, to think about rebalancing a bit. But there is a chance that we get this optimistic kind of view that's stronger than high single digit returns. And so if you combine those two together, we assign a 75% probability to relatively handsome returns over the next 12 months. Now, there are disappointing scenarios, and we highlight them there. We think that there's a 20% chance that you don't have a bull market top and an ugly bear market, but that you do get some type of pullback over the next 12 months. And that would be if inflation really was less transitory than advertised by the Fed, stickier, more of the wage price spirals that could cause margins to come in just a bit. And if that would happen, earnings growth would be slower than expected, and you might get some multiple contraction. And then we assign a very low probability to a pessimistic case that would be, stagflation. Inflation is far higher than expected. The Fed's behind the curve, and then you could get a handsome, decline in the market, but very low probability that we see that happening. And to put that base case in perspective, that's really just saying a 22 multiple on consensus earnings of around $211 a share or so. And actually earnings continue to come up. We've just gone through a very strong earnings season. And so, we're not stating that we're having far better outcome than is kind of expected in the market right now. We're saying, hey, you probably deliver about where it looks like the numbers are going to come in, for the year to get that kind of return. The reason, again, trying to differentiate between temporary short-term corrections and signs of a real bull market top. And bear markets last for multiple months, quarters, even, over a year. And they tend to be associated with, 9 or 10 signals that tell you this is more than just psychology. And we just don't see any evidence of this. These are the 9 things that we look at that kind of signal a bull market top or the beginnings perhaps of an ugly bear market. It's that blow off top that I talked about where you really get stretched PEs to levels that are far higher than norm, where you get heavy inflows into equity funds and everyone's buying stocks and selling bonds, where you have very heightened M&A activity, real rates start to rise significantly, you get weaker earnings, the erosion in the number of stocks making new highs and utilities and beverage companies, more defensive names leading, and credit spreads widening out and people fearing that, corporate bonds won't be able to pay principal and interest. None of that is happening right now. We do have heightened IPO activity, but that's about the only thing that you could check. All of these factors you would have checked off in 2000 and in 2007 and 8. They're just absent today. And so that's another thing that gives us confidence in saying, hey, we expect relatively healthy outcome over the next 12 months.
And Jeff, before we go on to the next slide here, SPAC
Yeah.
activity, that's been talked about quite a bit as a signal. Maybe you would lump that in with the IPO activity. Pretty strong earlier this year. We've seen a pullback in that. Do you include that in this more IPO activity, or do you look at that differently? And what are the behaviors that you've seen there as they've kind of cooled off here middle part of this year?
No, I would include that in this activity. And, that would be an area that we would say, this is a mosaic. That is a sign that as, stock market prices and multiples have come up, that's something to watch for. Is that a sign of froth? But again, it's a mosaic, and that's why we combine it with these other categories. And you're just not broadly seeing massive flows into equities over over the last 12 months on a rolling basis. You're not seeing these other things break down that would suggest that there's broader concern in terms of the top.
Great, thanks.
Sure. So these are just so you don't trust my check marks. This shows you the flows into equity funds. And on the left-hand side, you can see in the blue bars that they have come up. But then when you look at it on a longer-term 12-month rolling basis, you can see that flows into equity and mutual funds, continue, net flows continue on a 12-month rolling basis to be negative. So it's not like these other peak periods that we've seen that really was signaling that the average retail investor is just pouring in to equities, which tends to mark market tops. This is a picture of the 10-year Treasury yield. And, for those that are worried that, rising rates could, potentially end the rally, we were at 3.25%. I think people forget this back in December of 18. So, rates had come up to that 175 level since they've rolled over. They're still in an upward trend. We were at 0.5% if, you go back towards the beginning of the year, but certainly not at any kind of level that would cause you to, be concerned that bonds are looking far more attractive than stocks, and stocks compete for bonds with bonds for attention. Back in 2000, when we had the tech bubble and pretty ugly crash in the market, the 10-year Treasury was trading at 6%. So when you get strong earnings, a decent economy, and a differential, the earnings yield on stocks versus the bond yield still is very attractive. 53% of S&P 500 constituents have a dividend yield that is higher than the S&P 500. So, if the 10-year Treasury is trading at 6%, people go, wow, I could get 6% in a relatively risk-free bond versus the risk I have taken a stock. I think I'll go with the bond. Here, that certainly is not the case. So that's one of the reasons why we think valuation is still very reasonable. Yes, multiples are at 22 times, but that's happening at a time where earnings are coming up and being revised up. And also, if you look at the dividend yield, just the current income that you can earn off of a stock versus a bond is very attractive versus history. So that factors into our valuation analysis. And then you can see that credit spreads here remain at historic lows. Normally before, and you can see what they did in 07, 08, you can see what they did in 2000, they rise significantly. And bond investors are way smarter than equity investors. I'll be the first to admit it, even though my focus is on equities. When you're a bond investor, you're arguing about a few basis points. In equities, you're talking about, higher return differentials. And so you want to be really smart. And the bond market is not fearful of accelerating inflation this time. You see that in the Treasury market as the 10-year has come back down to less than 1.2%, and credit spreads are extremely tight. So this is a signal to us that inflation probably remains under control. Yes, it's accelerating, but not to fearful levels. The bond market certainly is not worried about that right now, and that is comforting to us as equity investors. Sector leadership remains in the cyclical camp. Here you can see that it's not utilities and staples that are leading the market. In fact, they're the worst performing sectors in the market. Generally towards market tops, you get people buying food and beverage companies and utilities. That's not happening. You see the more cyclical areas. You see real estate that's up there, surprisingly strong return for real estate. So leadership in no way is signaling some type of bull market top. And this is my yoga page. This is what I like to share. When people ask me about the market, here are the three levels of analysis that I've mentioned several times: fundamentals, valuation, and technicals. If you saw a bunch of red X's in here, that would be a time to say, Jeff, how can you be positive? All this stuff is negative. But there are all kinds of subcomponents to each of these categories making up fundamentals. You have trends in the economy. That includes our review of things like personal income and consumer spending, real GDP growth, capital investment, all kinds of stuff that compose this. Trends in earnings, Fed policy, so on and so forth. But you can see a lot of pluses here. Valuation, I just mentioned, looks reasonable or neutral if you put it in the context of interest rates. And then technical price trends. This is a relatively broad market. It's not like a few stocks are carrying the market. It's gotten a little less broad that makes me think you could have a correction, but it's in no way, if you look at the number of stocks advancing versus declining, suggesting anything like a bull market top, whatsoever. Most stocks remain in a nice long-term uptrend, and the percentage of stocks trading above their 2-day moving average of plus 90% is not typically what you see at a bull market top. So this gives us comfort and conviction to tell our clients to remain, invested in equities, and the outlook remains pretty solid. Now we do look at wall of worry items. I'm going to cover a few here in just the next few minutes. We do continue to monitor coronavirus and the Delta strain. Looks like that's going to be peaking in the next couple of weeks. Hospitalization and death rates are not rising dramatically or as dramatically as new daily cases. That's a positive. We're much better prepared to combat some type of resurgence than we were, back in the early stages of 2020. We think that this will be managed. Inflation is on the rise, but we do think a lot of it's transitory. 30%, over 30% of the contribution to inflation was used car prices. And then you had, travel, airline tickets, restaurant prices, those kinds of things coming up. They will anniversary, and they'll be more temporary in nature. And there are some other positives that we think offset this temporary kind of surge in inflation we're seeing, and we think it will ebb. Economic data is peaking, but we think that it will slow not to recession levels, but to still healthy levels. So we're not concerned about peak economic data. And I think I'll leave the wall of worry items that I highlight at those three right now. Human nature is to go to worst case outcomes and project the worst. That's what we saw in 2018 with regard to Fed policy and tariff and trade rhetoric. People just go to worst case outcomes and then speculate about recession, and that can cause pullbacks. But what we look at to determine how we want to invest and keep our clients invested is the data on the right. What does economic growth look like? What does employment trend look like? How about earnings? What about the level and trend in rates and credit spreads? And on those factors, we still give plus marks. And so that's why we say, let's deal with the wall of worry, and the market should climb this wall of worry. The items are manageable and the data is good. If the data is negative and the items look like they're not manageable, that's when bull markets end. So let's just take a couple of fear factors that are out there on the wall of worry. One of the things that you talked about, just in terms of peak economic data, people worry that this fiscal stimulus is going to end, and that's going to cause some type of slowdown. It's ending at a time where we're reopening, so the timing for it to decline is solid. And my question is, well, if it's declining, the amount of stimulus, is it declining to levels that are below where we were at kind of normal conditions back in 2019? And the answer is no, it's not. We saw excessive spending in 2020 and 2021 to keep the economy going as the economy shut down. And yeah, it's slowing in 2022 and 2023, but not to levels that were below what we saw pre-pandemic. So this fiscal cliff that seems to be in the news, I think is overstated. If we look at inflation, it is accelerating, no doubt. But as I mentioned before, you see the core and the headline CPI spiking in that top panel, but you can see that a lot of that is from used car prices alone and other items like this. And this will be temporary as supply chain issues ease within semiconductor land, and as we anniversary some of these excessive price increases after a period of decline in the middle of the pandemic. Also, labor productivity is increasing. That's a very positive sign to us. We get nervous about inflation if you get into an ugly wage price spiral. And that can happen if inflationary expectations rise, and also if unit labor costs are rising. But if labor productivity, if each worker is able to produce more and more, you can increase wages a bit without um, eroding margins. And we're heartened by the fact that we see strong trend in rising labor productivity, which should keep unit labor costs well contained. This shows you that earnings, the stuff on the right-hand side of that wall of worry page, earnings for 2021, uh, the estimated earnings growth has risen significantly from the beginning of the year. Now it's over 30, almost 37% as of this early print in July. Today it's over 40%. So earnings revision continues to be positive. Now, because of that, earnings are going to be higher this year. Earnings growth expected in 2022. The number hasn't come down, but the growth has come in a little bit because the number and the growth for 2021 has come up. But earnings are coming in at very healthy rates. If you look at service and manufacturing activity, it remains extremely strong. The chart on the left is results. It's an index taken from surveys from the Institute of Supply Management, where they ask folks in the manufacturing sector, are you hiring more? Are your delivery times being pushed out? Do you see growth? When you want to get concerned is when these lines dip below the 50 level, the 50 index reading. We've had a recession every time that's happened, and you can see historically going back how that's when you want to be concerned. The gray bars are the recessionary periods, and it's when they dip below that. We're well above those marks, and they continue to signal growth. CEO confidence is strong on the right-hand side. Small business optimism remains on an uptrend. Capital expenditures continue to come up. And if you look at TSA travel numbers and people eating out, they continue to improve. So these are all positive trending. We talk about value versus growth, and really believe that you should have a blend between the two. You do see periods historically. This line, when it's moving up, that tells you that value is strongly outperforming growth, and when it's moving down, growth is outperforming value. We think that right now, while value started to outperform in a handsome way, you can see that stalled a little bit, and we think it's likely that that will kind of continue, and that will be more at parity, and that innovation is the key, as I mentioned, that you want to blend between the two, just given kind of the underpinnings of the economy and where the growth is coming from. I'm going to lock this down. For those that do want value exposure, I just want to point out that the international markets are a great way to get that value or cyclical exposure. The S&P 500 is much more weighted towards growth. You can see the heavy value of the S&P 500 that's in information technology and in communication services, which would be your Google and your Facebooks. If you look at the international, the Europe, Australia, and Far East Index on the right, you can see that it has much more exposure to financials and industrials and materials, your minerals and mining stocks. So that international exposure is a great way to get some leverage to economic reopening plays, if you will, and to have some diversification to blend in some international for that value weighting. We think that's a great way to do that. And then I just close by saying, just because we get a correction in the next 6 months, should that occur, it doesn't doom you to a negative 12-month period at all. You can see many times you get intra-year temporary corrections, and yet the full 12 months ends up being very productive. So I'll leave it there. Those are my formal comments, and happy to take questions.
Okay, thank you, Jeff. Thanks for the presentation. As a reminder, if you have any questions, you can enter those in the chat box, and we'll go through those questions. Jeff, first question we have here is you mentioned rotating corrections across the sectors. Earlier in the
Yeah.
year, it was energy and technology. How can you tell the difference between a correction in a sector versus an overall just rotation out of that sector?
Well, if you look at those sectors right now, what we see is it was take within energy and financials, the stocks remain in a longer term uptrend, and yet they've pulled back. So it's not like everything is rolling over and hitting new lows. They still remain in positive trend over a longer period, but within in the last month or two, they've shown significant weakness. And the number of stocks hitting 1 month highs has come way in. So to me, the big difference, if you've seen just a total breakdown where they're hitting new longer term lows, and we just don't see that
Mhm.
occurring.
Got it. So you're looking at kind of early indicators, the 1 month high and 1 month lows.
We're looking at the fact that they appear to be oversold. Just looking on the percentage of stocks that are hitting 1 month lows have accelerated. The number that are hitting 1 month highs have come way down.
Mhm. Got it. And that's a great segue to question number two here. So you mentioned that 85% of the S&P stocks were above their 200-day moving average. When you're
Yes.
looking at the 200-day moving average, what percentage levels are significant for being above and below that 200-day moving average?
So you can slice it into deciles, and it's very rare for 90% of the S&P 500 to be trading above their 200-day moving average. Kind of a neutral reading would be in that 40 to 50% range, and then when you're looking for kind of oversold conditions, you get down to 20% or below. So it's kind of a range that you're looking at, but it's very rare where 90% of them are trading above their 200-day moving average. It's
And
a
Jeff,
sign of
that's
real
Great.
strength.
say that's one of the things that we've talked about on the podcast a few times is the benchmark that you're comparing it relative to, right? I'd be curious, the 200-day average, that's going to be in a fairly challenged market time, right? Would maybe indicate that a higher. So the benchmark that you're looking back to, where do those stand relative to pre-pandemic levels, or do you have that data handy?
I don't have that data. We could look at that, but going into the pandemic, it was I don't think anywhere close to 90% of the
Yeah.
stocks that were trading above their moving average.
Got it. And speaking of the S&P 500, we got this question here. Um, so how important is the PE ratio? So if we're looking at the valuation of the S&P 500, is it overvalued when you look at the PE ratio?
Well, yeah, that's the $1 million question. And so what I would tell you is that the PE ratio expanded significantly when earnings fell off a cliff back in spring of 2020. And they went to 20 to 22 times earnings immediately. And actually, they've been pretty flat ever since June of 2020. So they haven't continued to expand. If anything, they've come in just a little bit. And it's true that the average PE over long periods of time is around 15 times. So at first blush, you might say, hey, that's really expensive. But you have to put that in context because, you know, that PE history includes times when the Treasury was trading at 6 or 10% and times when it's trading like it is now at 1%. And they tend to be very low, PEs do, when bond yields are high, and they tend to be high when bond yields are low. So for an environment where you have historically low interest rates, I do not think that they're high. I think that they're more normal. And the other thing that we look at, you have to look at other valuation metrics. One of the metrics that we look at is the earnings yield on stocks. That's just simply the net income of a stock divided by its stock price. How productive they are in terms of earnings generation compared to a bond yield. And, you know, interest income is really the bonds earnings yield, if you will. But back in 2000, the earnings yield on stocks less the bond yield was negative. So, you know, bonds were yielding much more than stocks were. That's not the case today. The case today is that you have an earnings yield on stocks that it's positive. It's higher than what you can get on a bond in terms of the bond yield. So in that context, you could argue that the market is cheap. I'm not going to do that. I'm just going to say it's reasonably priced at this level of interest rates, and it's not expanding. It's actually, you know, coming in just a little bit after having that big bump back in the beginning of the pandemic. That's how I view it. Now, if rates all of a sudden we saw the Treasury at 4%, I would say, well, they're looking more expensive. Stocks are. I hope that helps.
That does. Thank you. And then we'll wrap up here with one final question. What are you seeing in the commodities market? Most notably, what's the story been with lumber pricing?
So, well, lumber pricing did shoot up. I think it was $1,500 or more, and it's come back in and come down. It's much more reasonable. Commodities are, you know, still at more peakish levels in the industrial metals, still strong in copper. So you still have that commodity level of inflation. Is lumber going to signal that these others are going to come in? You know, we'll have to see how that plays out. But energy prices have come up, as we all know, north of $70 for Brent, and that is you know, a headwind that companies will face in terms of commodity price pressure. So we're still seeing elevated commodity prices. That is true.
All right. And with that, we'll wrap up the webinar. Jeff, thank you so much for joining us. How can participants learn more about what you're up to?
Well, they certainly can look at our website. We post all kinds of information on the website. We have a monthly newsletter, investment strategy commentary, pieces on wealth planning. I just you know, recorded the crystal ball that's on the website. So, you know, please visit us, and you know, look forward to hearing from you all.